1 month ago, I used EFP to optimize a portfolio out of all the S&P 500 stocks, trying to beat the index while keeping the same level of risk. What came out was a portfolio heavily concentrated in semiconductors and energy. So now, 1 month later, how did it actually do? This is the month 2 update of EFP versus the S&P 500. Let's get into it. The 5 largest holdings from that portfolio were Lam Research, Valero, SanDisk, Phillips 66, and Western Digital. Chip names and energy names. Almost none of the mega cap tech that actually dominates the S&P 500. The link to that video is in the description. We built this portfolio on June 9th, so we're grading it on July 9th, exactly 1 month after, and the results are shocking. By June 30th, the portfolio was up 10%. A week later, July 7th, it dropped all the way down to minus 1%. By the July 9th cutoff, it had clawed back to 3.5%, just ahead of the S&P 500's 1.6. One honest caveat before I grade anything, the day that you check the results matters a lot. If you grade it on June 30, it looks like a blowout, but if you grade it on July 7th, it looks like a loss. So take any single month with a grain of salt and just look at the cumulative trends overall. So this is my grading rubric. 3 metrics get a fresh grade every month: forecast accuracy, return, and risk, while 2 metrics will evolve over time, which is the cumulative return and the win rate. Forecast accuracy gets a C. EFP predicted 3.2% returns for the index, and it landed at 1.6. Not bad, but not great. The optimized portfolio, on the other hand, had 12.3 expected return and landed at 3.5, less than a third of the forecast. Yes, it touched double digits along the way, but missing the actual endpoint by 9 points isn't accuracy just because it passed through the right number on the way down. Funny enough though, it did end right around the 3% mark, which is where it expected the S&P 500 to end the month. Monthly return gets a B. 3.5 beats 1.6. A win is a win, and beating the index is the entire premise of this experiment. But it's fair to note that this was a 2-point win rather than the forecast of a 9-point win. Risk gets a D. I'm using the max drawdown to calculate the risk, and it's basically the drop from the peak to the next valley of the price. The optimized portfolio fell from plus 10% on June 30th to minus 1% on July 7th, an 11-point swing. And the S&P 500's worst stretch, plus 2% on June 15th to minus 1% on June 26th, was about 3 points. The optimizer was constrained to target the same risk as the index, yet it delivered roughly 4 times the drawdown. That's a bad grade, and it should be. So now for the cumulative return, for month 1 is just the same as the monthly return, 3.5 for EF portfolio and 1.6 for the index. Win rate, 1 for 1 for EF portfolio. On paper, this month goes to EFP, but the margin was thin, the forecast missed by a mile, and the risk was far worse than expected. Now, let's move on to the portfolio for the period starting on July 9th. Quick heads up, I'm recording this video a few weeks after July 9th because I was just coming back from vacation, so I'm gonna use this little feature called the time machine. This lets me simulate exactly what the optimizer would have recommended using only the data available as of July 9th, no hindsight. I'll do a full video on how that works soon. Subscribe if you don't want to miss it. Same rules and constraints applies as last time. The mix is a lot more diverse this time. Healthcare is the largest sector by far, 35% of the portfolio, led by DaVita, Cardinal Health, and Merck. Tech drops to second place at 18%, led by Applied Materials, Dell, and Palo Alto Networks. And the largest tech holding is only the 13th biggest position overall. Energy holds on as the 3rd largest sector at 15%, led by Valero, Marathon, and Phillips 66. Of the last month's top picks, these 3 were the only names that survived into this month's portfolio. Everything else turned over. The headline for July is healthcare. The rest of the top 10 is rounded out by Bank of New York, Eli Lilly, Welltower, and CSX Corporation. The forecast. EF portfolio expects 2.5% return from the S&P 500 and an 8.9% return for the optimized portfolio. You can track this live. Just search EFP versus the S&P 500 under Watanabe Investing in the public portfolios. That's it for the month 2 update. Stay tuned to see how this healthcare heavy bet actually plays out. And if you think I'm being too easy or too harsh or just have any other thoughts on how I'm grading this, please let me know in the comments. And if you want to see whether an optimizer can actually beat the S&P 500 over the course of a whole year, make sure to subscribe. I'll see you next time.